Okay, hello everyone. So we're doing the question from week 5. It's currently 2:31 a.m. where I am. There's a Steers near me, so I might go get the Wacky Wednesday after I do this video. But anyway, we're doing question 3. I'm not going to do the theory, you can just look at the memo. So Blue Ball Limited is an unlisted manufacturing company with a financial year ending the 30th of September. That's what that 30/9 means. So we have the historical and the forecast data. Let's go to the question. The question is, determine the value of each ordinary share as at 30 September 2025. So we have to discount it. Gonna have to discount it to present values. Using the free cash flow to the firm valuation model, show all workings, and we can round our calculations to the nearest 1 million rand. What I've done here is I've highlighted all the information you actually need. So everything that's not highlighted, we don't really need. Except for I think this, but let me just highlight this or underline this. Cool. So what we will need is the current asset information. We will need this information about the loan. We'll need this information about the current liabilities for 2025 as well. So this is what we're going to need to do net working capital calculations. What we're going to need when we do the present value of future cash flow to the firm calculations is going to be the net capital expenditure for these 2 years and the depreciation for the 2 years. We're going to need the gross profit, whatever, and then administration and distribution expenses, and everything else is irrelevant. Okay, great. So let's get started. The way I would recommend you guys go about this is just have the formula for net working capital and present value of future cash flow to the firm with you, so you don't have to do it in this like confusing accounting style way. So the formula for net working capital is your inventory plus your trade and receivables plus your operating cash. So note, with operating cash, it's your total cash and cash equivalents minus your surplus cash, and then you also subtract your total current liabilities for a given year. The present value of future cash flow to the firm, that'll be your gross profit. You subtract your administration and distribution expenses. You subtract tax. You add depreciation. You subtract investment in net capital expenditure, and then you subtract your investment in working capital. So we need our net working capital for each of the 3 years in order to figure out the investment in working capital. That's why you calculate it. That gives us the future cash flow to the firm for each of those years, which is not yet discounted. Then when we calculate the n plus 1 year, so in this instance that's 2026, so the way we discount it is just basically you go future cash flow to the firm over 1 plus the WACC, which they give us here as, I believe, 12% to the power n. So in this instance, 2025 n equals 0, 2026 n is equal to 1. Then for the final year, which is 2027 here, what you do is you take the future cash flow to the firm. I think I've made a small mistake here, but basically you discount what you get for that specific year. And then what you also do is you take that value, you multiply it by 1 plus g over WACC minus g to get the total value, but it all makes sense when we go through it. And then what you do is your enterprise value. Now this is a very little calculation. You just put everything together of your present value of the future cash flows to the firms. You add your non-operating assets, which is your fair value of investments as well as your cash and cash equivalents. Then you subtract the fair value of borrowings. And then the fair value of each ordinary share, like they've asked us in the question, is just the enterprise value over the number of shares. Okay, so let's start. Let's calculate the net working capital for 2026. So if we go here, how do we calculate it? So we take our current assets, so inventory 273, and then we add trade and other receivables 306, cash and cash equivalents add 12. What do we subtract? Here, total current liabilities 406, and that gives us 185. Let's do the same for 2027. So 236 plus 294 plus 15, subtract 382, you get 163. We also need to calculate it for 2025, and this is where it gets not tricky, but just be sure not to make this mistake. So we go 206 plus 260. However, we add 68, but this is where this information is important. They tell us the company has 40 million of cash and cash equivalents surplus to the company's needs. And so if you'll remember the formula, if we go to net working capital, it's total cash and cash equivalents minus surplus cash when you want to calculate operating cash. So going here, that's why we say 206 plus 260 plus in brackets 68 minus 40, right? So plus 28. Subtract 324, we get 170. Then we want to know what is our investment. So this, what I have here is what is your investment in net working capital? That is how much you spend from year to year. So from 2025 to 2026, it was a positive 15 or 15 million. From 2026 to 2027, 163 minus 185, it's a reduction of 22, so negative 22. Cool, so that's a good setup. Now we can move on to calculating the future cash flow to the firm, which is what we want to do. So I've just put the numbers down here, but these numbers are just me inputting what the formula is. So let's go to where this information comes from. So here we have gross profit, that is 336. That is this over here for 2026 now. So we have gross profit of 336. Then I subtract the administration distribution expenses, which is 93. Then I subtract tax. The way I do it is I just multiply it by 1 minus the tax rate. So we've told the tax rate is 28% over here, 28%. So then all you have to do is you just have to take 336 minus 193 and you multiply it by 1 minus the tax rate. That gives you a value. You add 86. That 86 is our depreciation. Here's depreciation for 2026. Great. Then we subtract 100, net capital expenditure. There we go. And then we subtract the investment in net working capital. And so because from 2025 to 2026, there's an increase of 15, that means that in 2026, we already had the net capital of 170. We simply added 15. So we subtract that, we get a final value of 146. If we want to discount that, we say 146 over 1 plus 0.12. Sorry, not squared. You say 146 over 1.12. So that should give you 130.3. So they said in the calculations round down. So let me just quickly fix that over here. So not squared. Sorry, apologies. So, okay, cool. We've got a future cash flows for 2026. Let's do the same for 2027. This is obviously the one where the calculations is like a bit more tricky, but again, nothing crazy. Let's go to 2027. What is our gross profit? It's 295. There we go. What is our administration distribution expenses? It's 85. There we go. Then we multiply that again. 1 minus 0.28, that's the tax rate. Simple as. Then we add 92. That's the depreciation for the year according to the formula. Then we subtract 130. That's net capital expenditure. So easy peasy. And then this is where it's just be a bit careful here. So we have to subtract the investment in working capital. We know that from 2026 to 2027, there was a reduction in net working capital by 22. So when you do this calculation, you're going to subtract negative 22, which is the same as adding. When you put that all in your calculator, you get a value of 135. We're going to do a few things here now. Now we've got 135. Now we're essentially going to treat it as in perpetuity. So what we do is we multiply it by the 1.04. How do I get the 1.04? It is 1 plus the growth rate. So go to 0.6. They tell us that it's expected to grow. The free cash flows to the firm is expected to grow at 4% each year. So that's where I get the 4% from. On the bottom is 0.12 minus 0.04. So 0.04, just the growth rate. The 12% is the WACC, the weighted average cost of capital. Easy. That gives you a continuing value of 1,755. So what you do is you take the future cash flow to the firm for the terminal year, which is 2027. You add what the calculation you've done to give you the continuing value. You add them together. That gives you 1,890. Now, how do we discount that? So we put it all together. We say 1,890 over, not 1 plus 1.12, just 1 plus 0.2. So let me just fix that real quick for you guys. Easy peasy. So 1,890 over 1 plus 0.12 squared. If you round it, you get a value of 1507. So really pretty simple. The biggest problem is just that there's a lot of really useless information, and that can kind of make it a Lass, if you guys know what that means. Like the German word is make it a Schlepp, make it like unnecessary, make it a bit of effort to just go through it. But what I would suggest when you do this question is what I'm going to do in the test at least. Make sure you have your formula. I'm not sure if they give it to us, but I'm just going to study it. Make sure you have your formula, and then just look for all the values you need to plug into your formula, and look for small things like, when I do my operating cash, do I have to look for surplus cash? In this example, there wasn't any surplus cash forecasted for 2026 or 2027. It might be in a question, I think. So just, make sure of that. Cool. So now we've got all of that. What do we do now? Now we just need to go and calculate the enterprise value. So what we do is we take these two values. So we've got the continuous value, future cash flows to the firm of 2027. We've also got the discounted future cash flows to the firm for 2026. Great. Add them together. That gives you 1637. What are we going to do now? We're going to add our investments. So look at point 1. The company had investments which did not support the normal operations of the company, had a fair value of 120 million on this date. So we add that 120, we add the 40, which is the cash that is additional, and then we subtract 260, which is borrowings. Where do I get 260 from? You go over here in 20. Remember, this is as at the 30th of September 2025. So we don't care about the loans projected in 2026 and 2027. That doesn't contribute to our current value. If they maybe didn't give you this the value for 2025, maybe you had to discount it, then you could, but we already have the loan, the borrowings of 260 for 2025, so we just use that. So then what I get is this final value of 1537. So I've added my investments, I've added my cash that is surplus, and I've subtracted my borrowing. So cool, now I have the fair value of the ordinary shares. I have my equity, and then I want to get the value per share of the equity. I just divide it by 220. And that's basically it. Maybe I'll spend another minute just saying, it's very important, just highlight everything that is absolutely required. So here I've highlighted the investments. We use that when we calculate the enterprise value. The 40 million of cash and cash equivalents as at 30 September. I use that with my net working capital for 2025 and in the enterprise value calculations. And then, this, your 260, that's your borrowings for the enterprise value. Obviously, important information is how many ordinary shares we have, 220 million. So we're working in millions. So we just say 1537 million divided by 220 gives us the value per share, rounded to 2 decimal places. The growth expectancy, the cost of equity, for example, we don't actually use that in any of our calculations here. But the weighted average cost of capital is 12%. We use that in our calculations. The tax rate, obviously, and then here they say the carrying amount of the loan is considered to be equal to their fair value. So that's to say that, the cash value and the book value of the, weirdo accountant that wrote it down, those things are the same. Okay, so that's just this question. Let me know what the quality is like. I'm just using I'm just using the audio, the mic of my MacBook. I do have a mic, but I haven't set it up yet. And I'm using a tablet that I got today, so I'm still kind of getting used to it. But I think it should be good enough. And even if it's not good enough, I'm doing it for free. So yeah, thanks guys. I hope you enjoyed it, and good luck with the test on Friday.